ArcelorMittal, the world's largest steelmaker, launched plans on Friday for a $3 billion share issue to help reduce debt and cut costs. Having been hit by a plunge in steel prices which it blamed on a surge in cheap exports from China, ArcelorMittal share price has dropped 60% in the past 12 months, cutting the group's market value to just €6.2 billion, $6.94 billion. The shares were down a further 6.5% on Friday, making them by far the worst performer in the European FTSEurofirst300 index. The company, twice the size of its nearest rival, reported that its core profit EBITDA dropped by 32% last year to $5.2 billion and warned the result this year would only be in excess of $4.5 billion as it sees little improvement in overall global demand for steel this year. Chief Executive ArcelorMittal said that 2015 had been very difficult for steelmakers and miners, even with some rises in demand in Europe and the United States where the company does the bulk of its business due to Chinese exports depressing prices. Analysts said reducing the company's debt level was necessary as its debt is rated below investment grade, making it more expensive to maintain. It was needed as the balance sheet was becoming stretched, analysts at ABN AMRO wrote in a note to clients, adding that the group's bonds were yielding some 12%. Steel prices have slid to 12-year lows and global producers appear set for another year of pain even as prices start to stabilize due to production cuts. China, which makes half the world's steel, exported a record 112 million tons of steel last year, equivalent to total North American output, upsetting trade partners who argue it is dumping on world markets. It was revealed on Friday that the EU's top trade official has called on her Chinese counterpart to take measures to curb the overcapacity in China's steel industry and warned it would open 3 new anti-dumping investigations this month on steel imports from China. EU ministers met last year to discuss Chinese overcapacity and the threat to EU industry, following an urgent request from Britain where most of recent sector job cuts have taken place. On Thursday, India's Tata Steel Limited reported heavy losses in the last 3 months of 2015, blaming Chinese imports for having to axe 3,000 jobs at its UK arm, Britain's largest steelmaker. Raising more cash, ArcelorMittal also said on Friday it was selling for €875 million, $980 million, its 35% stake in Spanish automotive steel specialist Gestamp Automoción to the majority shareholders, the Ribas family, ending a joint venture formed in 1998. This capital raise, combined with the sale of our minority shareholding in Gestamps, will accelerate the company's debt reduction plans and enable us to reduce net debt to less than $12 billion. ArcelorMittal said, net debt was $15.7 billion at the end of 2015. The company, formed from the 2006 acquisition of ArcelorMittal Steel, has steadily pulled down debt from a September 2008 peak of $32.5 billion, but progress has slowed in the past couple of years. With core profit less than a quarter of its 2008 high, the Mittal family, which owns 37.4% of the company, has committed to taking up all their rights in the new issue, subscribing for shares worth some $1.1 billion. ArcelorMittal also said on Friday it was launching a new 5-year Action 2020 plan, designed to improve each of its 5 business segments and to return core profit EBITDA per ton to above $85. It fell to $62 last year. The group, which makes about 6% of the world's steel, said apparent steel consumption in 2016 would be flat to slightly higher, as stronger demand in the United States and Europe would be outdone by declines in China, Brazil and former Soviet states.